If you're trying to buy a home in 2026 and wondering, can I qualify for a conventional loan? Then this video is for you. We're going to break down the requirements in plain English. We're going to talk about credit. We're going to talk about down payment. We're going to talk about income and job history, debt to income ratio, mortgage insurance, loan limits, and the stuff that nobody explains until it's too late. And then I'm going to give you a quick update at the end because there's a change that started in late 2025 that matters if you're buying in 2026. It's one of those things that sounds amazing on the internet that still needs a reality check, and it has to do with Fannie Mae. But before we get started, I want to talk about what a conventional loan actually is. A conventional loan is simply a mortgage that's not backed by the government like FHA or VA. Most conventional loans follow guidelines from Fannie Mae and Freddie Mac. Now, you're probably wondering, does it actually matter to you? And the reality is no, not really. What does matter is that conventional loans tend to reward stronger borrowers, those with higher credit, lower debt, more money down. So if that's you, conventional can be the best deal in the mortgage world. But at the same time, you don't have to have the best credit score. You don't have to have some huge down payment. You don't have to have super low debt in order to qualify for a conventional loan. It just rewards those borrowers with even better interest rates than those that are kind of middle of the road. But either way, if you're wondering if conventional is the right loan for you, after watching today's video, you're going to know. Now, when it comes to conventional loan, there's really 5 pillars for loan approval. Think of conventional like a 5-part scorecard. It has to do with income and employment history, has to do with your credit profile, has to do with down payment and assets, your debt to income ratio, property and loan size, which essentially is the loan limits there. And that's really the gist of it. Now, before we get into it, I'd like to take a minute and ask a favor. If you find any value in my videos at all, make sure you hit that thumbs up and please consider subscribing to the channel to stay updated on everything mortgage and real estate related. Now, one of the questions I get all of the time when talking about loans is how long do I need to be on the job? How much income do I need to make? So I want to start by talking about the income and employment requirements. There's something that's called the 2-year stability rule. In general, lenders want to see 2 years of stable employment and income. Now, that doesn't mean you can't change jobs. It means you can't look like a financial roller coaster. Changing jobs is usually fine as long as you stay in the same line of work. That means if you're in sales, you're staying in sales. If you're in management, you stay in management. Say you're an electrician, you're still an electrician. There's no problem. Where it gets tricky is when you do a big switch, like you're a W-2 employee, you receive a paycheck from an employer, weekly, monthly, whatever, and then you become self-employed last month, and now you want a mortgage this week. And that's because if you're self-employed, most of the time, lenders want a 2-year history of self-employment to count that income reliably. And the reason for that is because income consistency matters more than the amount. There's no maximum income for conventional loans. There's also no minimum income. You can make $50,000 a year or $500,000 a year. What matters is whether your income is documentable and consistent. If your income is trending up gradually, that's usually fine. If it's $50,000 a year, then it becomes $150,000 a year, then $75,000 a year, then $200,000 a year. That's where underwriting starts asking uncomfortable questions. So again, just to reframe it, you want consistency in both employment and your income. Now, when it comes to credit score requirements, the classic rule for conventional loans is that you need a 620 minimum credit score. But in the real world, you actually want a higher credit score. The important part, even when guidelines say 620, many lenders out there have something on their programs called overlays, which is essentially a different requirement, if you will. So conventional says, hey, you need a minimum 620, which has actually changed, and we're going to talk about that here in a minute. But say they say you needed a 620. Well, many lenders out there put additional requirements on their programs and say, well, instead of a 620, we want you to have a 640 or sometimes a 660. And the reason they do that is to protect themselves, right? The higher your credit score, the better credit profile you have, which means that you're basically a stronger candidate. The lower your credit scores, the higher risk you are to that lender. So in order for those lenders to protect themselves, sometimes they put that additional requirement on there. So if you're sitting at like a 620 or 630 credit score, you may technically qualify in theory, but the terms can be ugly and approvals are going to be way harder. My advice is if you're barely above the minimum, you're usually better off improving your credit first. It's not just about approval, it's about your monthly payment. Better credit can mean a lot better interest rate and lower PMI, which translates into a much lower monthly payment and qualifying for more homes. Now, when talking about credit, one thing happened in late 2025 that I'm going to explain later in the video, and it's where Fannie Mae's DU system stopped requiring a minimum credit score for certain files. It's real, but it's not everyone gets a mortgage now. So there are people out there online, on videos, on YouTube talking about how you no longer need a credit score for conventional loan. And yes, that's true, but the reality is you still need a credit score, and you're going to need a credit score at least 620 or better, because otherwise you're not going to get approved for the loan regardless of what people are saying. Now let's talk about the third pillar of that scorecard when it comes to qualifying for a conventional loan, and that's the down payment requirement. You can buy a home with a conventional loan with as little as 3% down. Now, the myth out there is that you need 20% down for conventional financing. But in reality, conventional loans can go as low as 3% down for primary residences. Now, one of the questions I get all the time is, can you put more down? And the answer is absolutely. You can put 5% down, you can put 7, 8, 10, 20, 50% down. There's a minimum, not a maximum. But here's the honest truth about 3% down. If you're putting 3% down, you need to understand something. Conventional may not automatically be the cheapest monthly payment when comparing it to FHA. A lot of times, FHA wins on payment when you're doing the minimum down payment, especially if your credit is not that strong, because conventional PMI can get really expensive. So don't let your lender pick your loan program like it's their personal preference. Your lender should be showing you side-by-side options. When you're getting a loan, you're going through that pre-approval process, your lender should be showing you all of the options that you qualify for. They shouldn't be telling you, hey, you need to do a conventional loan, or you should never do an FHA loan. They should be giving you the options and letting you decide. Now, with that said, when you walk away from that pre-approval process, you should also know how much loan you qualify for, what the monthly payment would be, how much money you need to bring in at closing in order to get that loan. And the reason I bring this up is because people tell me all the time that, hey, I've been pre-qualified, but they're not getting the right information once they leave that pre-approval. So just make sure you're out there working with a professional. You're not just Googling online and trying to find somebody. In fact, if you want to get taken care of in a first-class way, make sure you reach out using that link in the description of the video. You can work directly with my team. We help hundreds of people here on YouTube, and we'd love the opportunity to help you as well. Now, when it comes to buying a house using a conventional loan, if you're putting less than 20% down, you're going to have something called mortgage insurance. Mortgage insurance is an insurance that lenders require on the loans because you're essentially a higher risk to them because you're not putting at least 20% down. Now, a lot of people get confused and think that that insurance is somehow protecting them. No, the insurance is there to protect the lender in case you default on that loan. And here's the thing, PMI is not optional if you're putting less than 20% down. If you put less than 20% down on a conventional loan, you're going to have PMI, which is called private mortgage insurance. Now, as I mentioned earlier, the lower your credit scores, the higher that private mortgage insurance is going to be. The higher your credit scores, the lower that insurance is going to be. So sometimes when you're putting a minimal down and you have those lower credit scores, they don't even have to be low. Say they're 680 or 700, you may be better off using an FHA loan when it comes to monthly payment because FHA has a lower mortgage insurance premium every single month. Now, at the same time, there's some downsides to using FHA as well. So it's not always a black and white decision. That's why your lender should be providing you options so that you can make the best decision for yourself. Now, one nice thing about mortgage insurance and conventional loans is that it can be removed. This is one of the biggest advantages that conventional has over FHA. With conventional financing, once you have around 20% equity in the property, PMI can often be removed by calling the lender on that loan. Now, sometimes it's automatic, sometimes you have to request it, sometimes you need an appraisal, but the point is it can go away. And yes, there are usually seasoning rules when it comes to that mortgage insurance. It's not typically that you bought the house last month and PMI is gone. Think more like 12 months-ish before lenders are willing to play ball in many of those cases. Now, before we move forward, I want to ask you a quick question. Do you think people should wait until they have 20% down to buy a house? Drop a yes or no in the comments and tell me why. I'd love to read them. Now, let's move on to the final thing in that scorecard, and that is your debt to income ratio. Now, this is the most misunderstood number in mortgages. Your debt to income ratio is simply your monthly debt payments divided by your gross monthly income, not your take-home pay. It's your gross pay before taxes, 401k, insurance, all of that. Now, with that said, let's talk about how lenders calculate your income. If you're a W-2, lenders typically look at your recent history and they average it. If you're self-employed, it's more document heavy. They're generally looking at tax returns and net income, and it's not always as friendly as people expect. What counts as debt? DTI is based on debts that show up on your credit report, things like car loans, student loans, credit cards, personal loans. What they're not doing is they're not counting groceries, gas, childcare, what you're spending on Amazon. That's your budget problem, not your underwriter's problem. Now, with that said, there's something called a front-end ratio and a back-end ratio when you're talking about your debt to income. Front-end ratio is your housing expenses only. That's what your mortgage is going to be with your principal and interest, your property taxes, your insurance, your HOA. And then the back end ratio is your housing expenses plus all of those other things that show up on your credit report. So let's say, for example, that you have a mortgage payment with everything included, taxes, insurance, HOA, everything at $3,500. Well, let's also say that you make $10,000 a month. Let's say you make $120,000 a year. We divide that by 12. So your gross monthly salary is $10,000 a month. If your housing expenses are $3,500, you take that $3,500, you divide it by the $10,000. That means your front end ratio is 35%, which would meet conventional guidelines. Now, when we talk about back-end ratio, your back-end ratio is your housing expenses. Again, we'll say $3,500 plus everything that shows up on your credit report. Let's say you have a car payment of $500 a month, and you got student loans for $200 a month. And let's say you have an installment loan for $300 a month. That's an additional $1,000, which basically means your back-end ratio would be that $3,500 plus the other $1,000. So that's $4,500 a month divided by that $10,000. So that means your back-end ratio is 45%. Now, here's the thing. In most conventional scenarios, you generally want to be somewhere around 45% back end to feel normal. In some cases, with strong compensating factors, approvals can push higher, even close to 50%. But the stronger the file, the more flexible everything gets. But understand, conventional financing won't let you go over 49.9%. Now, one of the questions that people often ask are, what are compensating factors? Things like higher credit, more down payment, more reserves, stable job history. Translation, the more you look like a safe bet, the more underwriting loosens up. One of the questions we get all the time is, can you qualify at a higher DTI, debt to income ratio? And the answer is sometimes. And one of the other things we get is, should you actually go that high on your debt to income ratio? And what I would say is that all depends on your budget and lifestyle. Sometimes people have income that's not being calculated in their debt to income ratio for one reason or another. Say they drive for Uber or DoorDash or something, and they make this additional income that's not being reported. Well, sometimes if you have additional income and your budget allows you to stretch that approval, then that's on you. But it shouldn't be your lender's decision to tell you how much home you can actually afford. They're there to tell you how much you can qualify for. It's up to you to determine how much home you can actually afford to purchase. So in layman terms, just because a lender can approve something doesn't mean you should volunteer to be house poor. Now I want to take a minute here and talk about one of the changes from 2025, something that changes almost every single year, and that's loan limits. Conforming loan limits matter, and that's because they have a maximum loan amount that they're willing to loan to you. Over that, you're typically in jumbo territory with different rules. For 2026, the baseline conforming loan limit is $832,750 for a one-unit property. Now, one of the reasons this is a big deal, because 2025, the base loan amount was $806,500. So we saw an increase of $26,250. Now, for many of you out there, it may not matter, but for those out there in higher cost areas, having that additional $26,000 could actually save you quite a bit of money. Now, in high cost areas, the one unit ceiling goes even higher. For example, like here in Orange County, you can go up to $1,249,125. Now, while we're talking about loan limits, I want to do a quick myth buster here for a moment. Every year people say raising loan limits makes housing less affordable. But here's the thing, loan limits rising doesn't make underwriting easier. It just keeps the conforming program aligned with real home prices, so more buyers aren't forced into jumbo rules just because the market moved. Now, earlier in the video, I talked about one of those changes that happened in 2025 with regards to the minimum credit score. And essentially what happened was Fannie Mae's desktop underwriting system, essentially the system where we input your loan if you're trying to get approved, right? We take all of your information, you input it in there, and that system says, yes, they're approved, you're eligible, if you will, or no, you're not eligible based on whatever requirements. Well, it changed its approach so that it no longer requires a minimum third-party credit score for certain loan files. Now, Fannie Mae describes this as a credit risk assessment change, and it only applies to new loan case files that were created after mid-November of 2025. Now, that's why you're going to see headlines like there's no more 620 minimum credit score, that, no credit score required for conventional financing. So what DU is actually doing instead is Instead of having a hard score cutoff, DU uses a broader risk assessment to determine eligibility. And on that same note, a lot of lenders in industry commentary are talking about incorporating a wider view of borrower behavior, including payments that don't always show up on a traditional credit account. So what does this not mean? This does not mean no credit, no problem, here are your keys. You still need to look strong overall on your credit profile. The best pricing still goes to borrowers with higher credit scores, lower DTI, more money down, more reserves, stable income and employment. So yes, it can open doors for thin credit files, but it doesn't magically create great rates or easy approvals. So if you're somebody out there thinking about getting pre-approved to figuring out how much home you can actually afford, let's talk about what you'll need and why it matters. First off, I want to talk about a pre-qual versus a pre-approval. A pre-qualification is basically a conversation. You call somebody up on the phone, you tell them, hey, I make $80,000 a year, have 3% down, these are my debts. Right? They don't ask for any documentation, whatever, and they give you a number and say, hey, you're qualified for this. That's what a pre-qualification is. A pre-approval is when someone actually reviews documents and runs the credit. So you have that same conversation. They say, hey, I need documentation to back that up. You send in the documentation. They run your credit report. That is a pre-approval. So if you're shopping homes, writing offers, or trying to compete, you want a real pre-approval. Period. Not a pre-qualification. Now, with that said, if you don't know where to start, my team and I would love the opportunity to guide you. Just use that link in the description of the video. Now, when it comes to documents that the lender is going to ask for, likely your pay stubs, like your last 2 pay stubs, are going to ask for W-2s, sometimes 2 years of them. Tax returns if you're self-employed. They're also going to ask for bank statements. They're going to ask for your ID. They're also going to ask for authorization to run your credit. And they're doing this so that you don't find out you have a problem after you fall in love with a house. Right? You're doing this before so that you know you can actually qualify to buy a home. Now, I realize a lot of you that are watching this video might also be considering an FHA loan, especially with a lower down payment. So let's just take a minute here and talk about the differences between conventional and FHA and why conventional loans can actually be better. Conventional often wins long term because there's no upfront mortgage insurance premium like FHA. Also, PMI can be removed once you hit that 20% equity in the property. Also, stronger borrowers get better pricing. But at the same time, FHA can still be a better fit if you have weaker credit, you're doing a minimal down payment, or sometimes a conventional PMI is punishing your payment. Your lender should be running both, as I mentioned earlier, side by side and letting you decide. Now, some of the questions we get around conventional financing is, can I buy a primary, a second home, or an investment property using conventional? And the answer is yes. Conventional can be used for a primary, second home, or an investment property. The catch is requirements tighten and down payments usually increase as you move away from your primary residence. So if you're buying a second home or an investment property, you're going to have to put more money down. You can't do the 3% down minimum, right? I believe the minimum down with conventional financing at the moment for an investment property is at least 20%. Another question we get all the time is, can I use conventional more than once? And the answer is yes. Conventional is not a one-time program. You can use it multiple times, assuming you qualify. Now, when it comes to down payment, one of the questions we often get is, can I buy with gift funds? Funds from parents, family member, whatever. And the answer is yes, most of the time, depending on the scenario. Make sure you talk to your lender so that they can structure it correctly. That's one of the reasons we talk about not trying to figure this out on your own. Make sure you call a professional, have them walk you through the process. But most of the time, the answer is yes. Now, when it comes to closing costs, they vary by state and lender, but plan on having money beyond the down payment unless you negotiate seller credits or lender credits. Now, the biggest mistake I see people making in this market is waiting too long to talk to a lender because they're not ready yet. If you're thinking about buying in 2026, the best move is to start the conversation early, not because you need to rush, because if something needs to be fixed, your credit, your assets, your DTI, your job history, you want time on your side. And as I mentioned earlier, if you don't know where to start, make sure you use that link in the description of the video. At the same time, if you found this helpful, hit the like button, subscribe, and drop your questions in the comments. And lastly, tell me this, what do you think is the hardest part of qualifying right now? Is it the credit? Is it the down payment? Or is it the monthly payment? Let me know in the comments. As always, I appreciate you watching. See you on the next one.